Accenture has reported its third quarter fiscal 2026 results, triggering an immediate 18% single-day stock crash. The drop was sparked by the company lowering its full-year local currency revenue growth guidance to 3 to 4%, down from its previous range of 3 to 5%. This growth downgrade represents a tangible market confirmation of long-standing fears that generative artificial intelligence is structurally disrupting traditional IT service providers. This growth downgrade has caused a dramatic derating of Accenture's valuation. The company's forward price-to-earnings multiple has compressed to approximately 11x, representing a massive discount to its 5-year historical average of 25.3x. Investors are aggressively repricing the stock as they reassess the long-term margin and growth sustainability of IT consultants in an era of automated software development. At the core of Accenture's challenge is the threat AI poses to the traditional labor arbitrage model. IT consulting firms have historically generated revenue by billing hours for manual software engineering and system integration. As generative AI models automate coding and automate development pipelines, corporate clients are demanding faster delivery at lower costs, eroding the billable hour moat that consulting firms rely on. While software service companies face headwinds, hardware infrastructure providers continue to capture outsized market margins. Investment firm Aletheia Capital has released a deep dive report forecasting that the combined value share of DRAM and high bandwidth memory in AI systems will rise from 40% today to over 70% by 2027. This indicates that memory is capturing a larger share of AI capital expenditures relative to logic processors. This shift in value reflects the physical bottlenecks of AI scaling. High bandwidth memory has emerged as the critical packaging bottleneck and margin capture point in the semiconductor supply chain. Because AI clusters are constrained by memory bandwidth rather than raw compute speed, memory chip design and dense packaging are capturing the primary economic premium in AI hardware infrastructure. In individual equities, Intel shares jumped 10.64% following a social media post by Donald Trump reporting that Apple has agreed to shift chip design and manufacturing to Intel's domestic U.S. foundries. While neither Apple nor Intel has officially confirmed the partnership, the report has generated significant retail optimism regarding Intel's turnaround prospects as a contract manufacturer. From a strategic perspective, a potential Apple-Intel partnership aligns with Apple's goal to diversify its chip supply chain. Currently, Apple relies almost exclusively on Taiwan Semiconductor Manufacturing Company for its leading-edge processors. By establishing domestic U.S. manufacturing links through Intel's foundries, Apple reduces its geopolitical risk exposure while helping secure local capacity amid global foundry constraints. Major U.S. defense contractors are facing a significant policy threat from Congress. The Senate Armed Services Committee has advanced a provision in the fiscal year 2027 Defense Authorization Bill that would generally ban defense contractors from executing stock buybacks or paying dividends without direct approval from the Department of Defense. This provision directly threatens the capital allocation and shareholder yield thesis that has anchored defense stock valuations. As the second quarter draws to a close, technical fund flows are expected to drive near-term market volatility. Due to massive equity gains earlier this year, the top 100 U.S. pension funds have seen their funding ratio rise to 110%, the highest level since 2001. To lock in these profits, pension managers are executing mechanical rebalancing flows, selling billions of dollars in equities to purchase bonds by the end of June. Within software, Adobe's latest quarterly results show a clear deceleration. The company's revenue growth has slowed to 11%, with GAAP earnings per share growth at only 8%. This indicates a potential loss of market share or slowdown in demand for traditional software offerings as the AI era evolves. Furthermore, Adobe's decision to shift its primary financial reporting from user growth metrics to annualized recurring revenue suggests underlying pricing pressures. Analysts note that such reporting changes often occur when a company seeks to shift attention away from a plateauing user base, as it defends its moat against new AI competitors. Adobe's earnings quality is further impacted by high stock-based compensation. The company spends approximately $2 billion annually on share-based employee incentives, resulting in a 3% annual dilution rate for existing shareholders. This dilution rate offsets a significant portion of its organic earnings growth, compounding valuation risks for investors facing slower sales expansion. Finally, in corporate credit, SpaceX is planning a massive debt refinancing. Bankers are preparing a bond offering of at least $20 billion in investment-grade bonds. The proceeds are intended to refinance outstanding bridge loans maturing in 2027, which were originally used to fund the company's acquisition of xAI.